Hey guys, hope you're doing well. In today's video, we will talk about 8 big differences between regular banks versus private banks, and at the end of this video, there is a bonus point, so make sure to stay till the end. But before that, please subscribe. Now let's get started. Point number 1. Who owns the bank? Now when it comes to regular banks, they are owned by shareholders. Shareholders are basically people who own shares in the bank. They can be individual investors or large institutions like mutual funds or pension funds. And the goal of these shareholders is to make money, right? They want to see the bank's profits go up, and they also want the share price to appreciate over time. This is why public banks often focus on maximizing profits and increasing share value. Now, on the other hand, private banks are typically owned by a small group of individuals, families, or even just one person. For example, HSBC Holdings is 69% owned by the family of its founder, while Credit Suisse is majority owned by its management and employees. This means that private banks are not under pressure to maximize profits for shareholders, but rather they focus on providing excellent service to their clients and building long-term relationships with them. Point 2. Customer service. When we talk about regular banks, customer service can vary greatly depending on the specific bank and country. However, in general, it's safe to say that the customer service at regular banks is usually pretty transactional. What do I mean by this? Let me take an example. Say you walk into a regular bank branch and ask a banker for help with a complex financial product. The banker takes the time to explain everything to you and helps you decide on the best course of action. But once the transaction is complete, the relationship between the bank and you, the customer, pretty much ends there. It's like the classic "we'll be with you for life" slogan. We just don't see that much of it. The reason for this is that regular banks typically have high customer acquisition costs because they target mass market. And this means that they spend a lot of money on marketing and advertising to reach as many people as possible. As a result, they only have so much money to spend on customer service, and they typically prioritize serving new customers over existing ones. On the other hand, private banks really go above and beyond to provide exceptional customer service. After all, they are in the business of managing the wealth of their clients, and this requires building strong relationships based on trust and personalized attention. Private bankers are typically very responsive to their clients' needs, and they will go out of their way to accommodate them. One thing to note here is that unlike regular banks, private banks do not need to spend much money on acquiring new customers because their client base is mostly made up of referrals, so they tend to have more resources available for customer service. Point 3. Minimum balance requirements. Regular banks often have relatively low minimum balance requirements, which makes it easy for anyone to open an account. However, these banks typically charge monthly maintenance fees if customers do not meet the minimum balance requirement, and these fees can add up quickly. Private banks, on the other hand, they usually set higher minimum balance requirements in order to qualify for their services. This is because they want to attract high net worth individuals and families who can afford to maintain large balances in their accounts. However, once you meet the minimum balance requirement, you can expect to receive a wide range of benefits that make it worthwhile. For example, many private banks offer exclusive discounts on financial products and services such as loans, mortgages, and investment products. They also often provide access to a team of dedicated professionals who can help you with all aspects of your financial planning. Point 4. Loan options. Now when it comes to regular banks, they usually have a wide range of loan options available to their customers. This can include personal loans, auto loans, home loans, and business loans. However, the downside is that the interest rates on these loans are typically higher compared to what private banks offer. Now, private banks typically only offer loans to their most trusted and valued clients, and they generally do so at very competitive interest rates. For example, a private bank may offer a loan of $1 million to a wealthy individual or family at an interest rate of 5%, when the market rate for a similar loan is 7%. Point 5. Investment options. Now, regular banks usually offer a limited number of investment options to their customers. These options may include savings accounts, certificates of deposit, and basic brokerage accounts. Private banks, on the other hand, they typically offer a wider range of investment options. They have access to a variety of sophisticated investment products and strategies that are not available to the general public. For example, they may offer their clients access to private equity, hedge funds, and other alternative investments. They also often have in-house investment advisors who can develop customized investment plans, tailored to the specific needs and goals of each client. Point 6. Fees. Fees charged by banks are another key difference between regular banks and private banks. Now, regular banks typically charge customers a range of fees for various services, including monthly maintenance fees, overdraft fees, ATM fees, and so on. Now, private banks also charge fees for their services, but they are generally much higher than those charged by regular banks. However, The higher fees charged by private banks are often justified by the wide range of benefits and services that they offer their clients. For example, many private banks provide 24/7 access to their services, while regular banks may have limited hours of operation. Private banks also typically have more convenient locations, such as in the heart of major cities, while regular banks may be more spread out. Point No. 7. Privacy. Regular banks typically have to comply with government regulations regarding customer privacy, which means they may be required to disclose customer information to authorities in some circumstances. Private banks, on the other hand, they have more stringent privacy policies in place to protect the confidentiality of their clients' information. This is because they often deal with very high-profile and wealthy clients who require a high level of discretion. In addition, private banks typically have more robust security measures in place to prevent data breaches and other security incidents. Overall, customers who value privacy and discretion will likely feel more comfortable banking with a private bank. And now, moving on to the last point, which is the bonus point that I promised, and that is the availability of these banks. Now, regular banks are widely available, meaning anyone can walk into a branch or open an account online. Private banks, on the other hand, are not as easily accessible. Many private banks operate by invitation only, meaning that they will only accept clients who meet their minimum requirements. This exclusivity adds to the prestige of private banking, but it also means that those who are interested in private banking services may need to go through a lengthy application process before being accepted. So overall, when deciding whether to go with a regular bank or a private bank, it's important to weigh the pros and cons carefully and choose the option that best suits your individual needs and priorities. While private banks offer a wide range of benefits, including personalized service, exclusive products, and competitive fees, they are not necessarily the best option for everyone. If you are a high net worth individual or family, however, then private banking may be worth considering. And with that said, thank you so much for watching. Please remember to subscribe if you haven't already. And if you have any comments or questions, please post them below. Thank you again for watching, and I will see you in the next video.